Today I want to analyze ASML. It's a Dutch company that makes high technology machines used to manufacture computer chips. These machines are called lithography machines, and they help companies like TSMC, Intel and Samsung to produce the chips found in smartphones, computers and other electronics. ASML is the only company that makes extreme ultraviolet lithography machines, which are needed to produce the most advanced computer chips. Because they are so hard to make at the current point, there are no other companies that can compete with ASML, giving it a strong and unique position in the market. So if we take a look at the stock price, we can see we are down close to 24% in the 1-year chart. And in the 5-year chart, we are still up around 230%. So overall, this company has a good performance, but right now it's trending down in the last year. So we're going to take a look at the financials to find out if this company is a good buy right now. ASML has a current market cap of $281 billion, which makes it the 4th largest company in the semiconductor space. So we also have a dividend yield of around 0.92%, which we can see here that the dividend also increasing many years in a row. The first thing we're looking for is revenue growth in the last 5 years. We want to invest in a growing business or a declining business. So we can see here in 2020, the revenue was around 14 billion euro. This was an 18% increase from 2019. Then we had the 32% increase in 2021. Then the 13% increase in 2022. Then again, the very strong increase around 30% in 2023. And then around 2% increase in 2024. So overall, what we can see here, we had the strong revenue growth in the last 5 years. So it's a check here, but we also can see the growth is slowing down in 2024. The next thing we're looking for is a free cash flow growth in the last 5 years, a very important number because the free cash flow can be used to pay the dividend, to pay the stock buybacks, to invest in the business, and also to pay back the debt. So we want to see that grow, and we can see here in 2020, the free cash flow was around 3.67 billion euro. This was a 46% increase from 2019. Then we had the strong increase in 2021, around 171%. Then we had the decline around 27%, then the decline again around 54%, and then the strong increase again around 176%. So overall, we can see here we had the good free cash flow growth in the last 5 years, so it's a check here. We can see the gross profit increased in a very good rate in the last 5 years. Even in 2022 and 2023, we saw the growth here, despite the free cash flow had a decline in 2022 and 2023. So this is the indication for the huge investments in research, also delayed payments from customers, higher working capital, and higher capex. So I think this company investing in the future, that's why the gross profit increased, but the free cash flow declined in 2022 and also in 2023 as well. The next thing we're looking for is a free cash flow yield over 4%. This can also tell us about the valuation of this company. If it's under 4%, it can indicate an overvaluation. So we're going to take the free cash flow from 2024, 9.1 billion. We're going to divide it with the current market cap of around 258 billion. And then we're going to get the free cash flow yield for 2024. The number we get is around 3.52%. So this is under 4%, so it's not a check here. And this can indicate an overvaluation with the current free cash flow yield. But we should also consider that this company can increase the free cash flow in the future. So if we take some assumptions for the future, we can see here, this website says that the company could have a free cash flow in 2025 around 6.4 billion, in 2026 around 9.8 billion, and in 2027 around 11.7 billion. So overall, maybe we should take the assumption that in 2027, the free cash flow could be around, let's say, 11 billion. So then we're going to take this number now with the current market cap of 258. And this would be a free cash flow yield of around 4.26%. So overall, this is still over 4%, but it's not a great number, I would say. Even if we say that in the future they can increase the free cash flow, I think this company still looks a little bit expensive. The next thing we're looking for is the debt to free cash flow ratio under 5. This means the company can pay back the debt with the free cash flow in under 5 years. A very important number, because if a company has too much debt and cannot repay the debt, it can risk to go bankrupt. So what we're going to do now, we're going to take the long-term debt of around 3.7 billion. Then we're going to add the short-term debt as well of around 1 billion. Then we're going to divide it with the current free cash flow of around 9.1 billion. So the number we're going to get is around 0.51. So this means in a little bit over 6 months, we can repay the debt with the free cash flow. So this is a very good number. It's a check here. And we also can take a look at the cash on hand. So how much money this company has in the bank. We can see here over 12 billion. This is a great number as well. We like to see that. The next thing we're looking for is the enterprise value to free cash flow ratio under 25. So this can also tell us about the valuation of this company. The lower the number gets, the more this indication for undervaluation. So what we're going to do now, we're going to get the enterprise valuation. So this is the market cap of 258. Then we're going to add the debt of around 4.7 billion. Minus the cash, so the cash was around 12.75, and then we're going to get the enterprise valuation. So the number we get is around 249.95. So then we're going to divide it with the current free cash flow of around 9.1 billion. So the number we get is around 27.46. So this is not under 25, so it can still indicate an overvaluation, but we can also calculate this number now with the assumption that in the future the free cash flow could increase. So if we're going to do this, I think we will get a better number. So we're going to take the enterprise valuation and then we're going to divide it with the free cash flow of 11 billion. So if we're going to calculate this now, we're going to get the number of around 22. So I think if the free cash flow can increase in the future, I think the valuation right now can be quite good. Not extremely cheap, but it can be in a good valuation, I would say. The next thing we're looking for would be shares outstanding decrease. This means the company buys back their own shares. We like to see that, especially if we think the company is undervalued. So what we can see now, we can see that this company had a lot of shares buybacks in the last years. We can see 2021 around 3%, around 2% in 2022. But now we can also see it's slowing down, so they're not buying back a lot of shares. So overall is a check here, but we also need to consider we don't like them buying back their own shares if it's expensive. I would like to give my conclusion about this company, so let's start with the positive. So we had the good revenue growth in the last 5 years. We had the good free cash flow growth as well. We have a very good balance sheet, which means low amount of debt and a good amount of cash on hand. I also think it's a very strong business actually. They have a strong market position and they producing very important machines. So the valuation is okay, I would say. It's not very cheap with around enterprise valuation to free cash flow ratio of 27. But if we consider that this company can grow the free cash flow in the future, I think it still can be a good buy right now. If you found this video helpful, don't forget to like and comment and subscribe for more content.